Good afternoon, everybody. Good morning to those on the Western Seaboard, and welcome to our second webinar for April, talking through the fixed income markets in Asia and obviously more specifically the Premium Asia Income Fund. For those who don't know me, my name is Jonathan Wu. I'm the Executive Director as well as the Chief Investment Specialist here at Premium Asia Funds Management, and I welcome you all today to today's webinar. We've got quite a lot to cover off today, obviously, as the market has moved dynamically over the last 12 months, which is why I've asked Gordon Ip, who is the CIO of Fixed Income and the Portfolio Manager for the Premium Asia Income Fund, to join us today to sort of talk through all the issues in quite an in-depth way. Now, you will see on your panels that there is a question box. Please feel free to ask any questions and we'll try to cover off as many as possible at the end. And if we don't have time, then I will personally come back to each of you with answers. If I don't know the answer, I will seek Gordon's guidance for that. So today will be about an hour long, just to cover off many of the issues. And so I hope everyone can get good insights out of it. So jumping straight in, Gordon, we've got a lot to cover today. And I guess first let's address the elephant in the room. What's happening in China, in your view, both from a sort of policy and economic standpoint?
Hi, Jonathan. Good to be with you guys. So yeah, I mean, if you follow the news, right, if you compare to the webinar that we did last time versus now, it feels to us that every 6 months the whole world has gone through some phase changes, significant phase changes, right? So if you rewind back to the last webinar, for example, we didn't have Russia, Ukraine, the situation. And the market was just kind of expecting, global rates will be higher, and people knew about the inflation problem, but it's not as forefront as right now, right? So right now, fast forward to today, first of all, in China, we would say that compared to the last webinar, in terms of the pandemic situation and also the economic situation. At the last webinar, China was arguably, a little bit ahead of the rest of the world, right? Fast forward to today, you can see, China right now, they have a new wave of COVID lockdown, predominantly in Shanghai. There was a small lockdown in Shenzhen, which basically shut some of the production in Shenzhen. And also recently, as recently as yesterday, the Beijing start to have some kind of lockdown as well. But if you look at the rest of the world, the US, the Europe, they all have opened up, right? So right now, China is moving at a very different phase or frequency versus the rest of the world, whether it's the performance of the economy as well as on the pandemic situation. Okay, so I think right now, after the 2 sessions, the government has announced that they will try to achieve a 5.5% GDP growth this year. But given the severe lockdown in Shanghai, was in Shenzhen, and currently going on in Beijing, I think it's increasingly difficult for the government to actually realize a 5.5% growth this year if they don't roll out relaxation measure in the second half of this year. So I think right now it's kind of wait and see approach that first of all, we need to pay attention to the pandemic situation. We need to assess how long this lockdown is, especially I think China is pursuing a so-called COVID zero policy, which arguably in reality is pretty hard to achieve, right? So I think at some stage, China will have to reopen up, or they just have to accept a non-zero COVID policy. In addition, they will need to roll out relaxation measure on the economy and also on the monetary front.
Yep. I mean, do you think that what the government's done a little bit of cutting in terms of the RRR rates? They've done a little bit of movements in terms of policy here and there to try to speed up things like mortgage approvals and things like that. Is that enough in your opinion, or is this it's quite shallow and it's not, I guess it's not broad brush enough at this point? They need to do way more.
Yeah, I mean, that's a very accurate observation, Jonathan, is that we think they have done too little and probably a little bit late. I would expect it earlier would be better. In terms of the magnitude of the cut, it just, very insignificant in our view. Given the severity of the lockdown and all the slowdown in the economy, I think they could have done more, but they are doing a sort of wait and see approach because just to recall, right, before all this, one of the priority of the Xi Jinping government is to deflate the economy because in the past the economy has been growing on borrowing leverage, right? So they are quite cautious about relaxing some of these liquidity because they don't want this liquidity to channel into in the appropriate area, meaning specifically in the property sector, right? So I think they are doing it slowly. So basically, if today the slower they add and the smaller magnitude they add on relaxation, the bigger magnitude and faster they will have to catch up in the next 6 months.
Yep. You make reference in the slide that we're showing up now. Obviously, the US is raising rates, and the Fed also was a bit more hawkish earlier this week, saying that inflation is really, really high, so we may have to increase rates even faster. Is there much relevance to to what we're doing, what we're investing in, and the markets that we're participating in compared to the US in that sense? Is there of any relevance if they raise rates faster or slower?
Yeah, because market price risk asset by expectation, and everybody knows on Finance 101, present value is a function of discount rate, right? So if that discount rate become higher, risk asset has to adjust downward the valuation. It's just simply as that. And U.S. interest rate, especially for U.S. dollar denominated asset, they all price off the U.S. Treasury curve, right? So even though we are investing in Asian name, most of our holding are denominated in US dollar, and therefore it will be impacted by the movement of US Treasury yield curve, right? So I think the expectation of the Treasury, US Treasury, will have, if not direct, it will have an indirect impact to the valuation of US dollar asset in our region, specifically through the risk-free rate. Okay, right now, when I make this presentation, the market was expecting 50 bips both this May and in June, and subsequent increases will highly depending on the data coming out in the future. But a recent talks from a Fed official make the market think that the Fed may even be more hawkish than the 50 bips in May and June, right? So that's why you see, the U.S. Treasury 10-year shot up to even close to I think at one point reached 3% on the 10-year, right? So for us to take advantage of this view is that in the Premium Asian Income Fund, we actually shorted some 10-year Treasury when it was at 1.65%, right? So we shorted at 1.65. Right now we are anywhere between 2.8 to 3.0. Then that hedges or tactical bet has make us some money on that front. But nonetheless, even though so we have to watch U.S. interest rate both on a tactical perspective and also on gauging the sentiment of the U.S. dollar asset globally, including Asia.
Yep. Now, moving on to given it's the largest portion of the market, and all of our investors are very interested to see what's happening with the property market in China. I mean, that is the bigger elephant in the room. And obviously the consolidation that we've seen over the last 12 months is the worst that we have seen since the fund started in 2011, and is obviously also reflected in the unit price of our fund. I guess what's been interesting, as a reflection, is I talked to one of our largest investors in New Zealand yesterday, and their investment committee briefing them on an update similar to this, and they're actually not concerned about the unit price dropping. They're actually, more concerned about the sustainability of income. And I do want to repeat this a couple of times during this hour, and confirm directly from the horse's mouth, being Gordon, that none of the bonds that we're holding in the portfolio has stopped paying income. Right? They've continued to pay income as scheduled and not defaulted. And so that's, to unit price movements are unit price movements. That's the reality, just like in government bonds at the moment. But the income is sustainable. That is, that is the true answer. Going back to the property market, I mean, Gordon, what's happening? Is it really, really bad right now? Have we come out, the back end of it yet, you think?
I mean, I have to be honest with you. We are still in the midst of this adjustment, but I think this property downturn has been going on for at least 24 months, right? We've been here talking about property for like forever.
Yes.
But I think if you look at the market action right now, from what I feel the market, and also for my talk to investor, I think it's good to gauge the current state of the market in terms of sentiment, all right? So if you, again, I study some psychology in university, and I think to analyze sentiment of a person is usually when you see something that you don't like, you first will be deny it, right? And then you become angry, and then you want to negotiate about better terms. And then you comes into some sort of acceptance, right? Depression, and then acceptance right now. So I think for my view of the investor, we are probably in the last two stages, which is either the investor continue to be quite depressed of what they've seen on their statement, or they have basically just accept what it is, and then just try to move on. Okay. So I think although we are still in this adjustment, I think at least we are in the last few innings of this game.
So either we're looking at that same sort of binary outcome that everything basically goes hell in a handbasket, and we forever are in an incredibly depressed environment, or something does have to turn. Do you think it's going to take more policy first to turn sentiment, or do you think sentiment will turn purely based on valuation first? Just from your assessment right here, right now.
Definitely policy, right? Everybody knows Asian credit, in particular Chinese credit, is cheap. From whatever angle you look at it, right? You look at spread, you look at absolute valuation, you look at dollar price. Every angle you look at it, there's no argument at all. This market is cheap, has been cheap, and likely will continue to stay cheap unless we see a substantial policy relaxation, right? So policy has to take the lead. At the stage of the market, again, usually we need the policy to bottom, and then investor get less optimistic, or even starting to become a little bit more optimistic. And then the last stage is they actually pull trigger to put money in, right? So right now, I think, especially given the current stage of the Chinese economy, if the government needs to achieve 5.5% this year, and given all the lockdown right now, I would say that on the policy front, in terms of restrictive policy, policy probably has bottomed, right? Meaning they won't go more restrictive. There may be a chance that there will be some relaxation here and there to support the economy, right? So I think policy has actually taken a more step to take the lead, but investor sentiment right now, honestly speaking, they are still not completely believe, and they may still concern, right? Because they are still depressed and not fully accepted, right? So again, if you look at the market sentiment and also look at the policy versus the market technical, I think, from both these angles, we think the market has slightly bottomed, right? But that doesn't mean that it will go up instantly next month or two. This recovery process will likely take some time, meaning especially because we expect that the relaxation policy from the Chinese government will likely to be rolled out on a slow pace.
Because the reality is that, okay, if we play the almond getting card and play out this narrative, and we're saying that the Chinese property market is priced for absolute disaster, the government can't actually go down that path anyway, because fundamentally property is still a core part of the economy, and actually it's a core part of most economies, right? Because people care so much about housing. I mean, if you look at the slide that we put up here, I mean, the bottom half of it is you're seeing the PE ratios forward looking for 12 months. And right now, the PE of the Chinese listed property developers is like 4 times, right? And we sort of talked about this yesterday with Renee and Doris in the equities update. And we have our 4th largest position in the Asia Equities Fund is China Resources Land, because it's so cheap and it's an SOE. So if you consider that in light of this context, it is priced for cataclysmic death, or another advisor mentioned me the trifecta of death. Now there is this sort of one slight hope on this slide, Gordon, and in March this year there has been some sort of turnaround on a month-on-month basis of developers' contracted sales. Is that a dead cat bounce, or or we're just coming off such a low base because it's fallen 50% in 12 months? How do you read anything into that bounce in March for property sales?
I mean, in a way, it's kind of expected, because the year before it was COVID lockdown, it's basically 0 contract sales, right?
Yep.
So anything they achieve, that time is basically compared to 0 or even negative from the previous year. So I wouldn't pay too much attention to that. But the most important thing it is to monitor the trend. The contract sale, the trend was going through secular downturn, right, because of this restrictive measure from the government. Yeah.
Yep. On the right-hand side of this chart, you also see the defaulted developers. So we don't hold any of these. We haven't held any of these. But Gordon, you mentioned to me the other day, this is only a fraction of the number of defaults, isn't it? It's actually quite widespread now.
Yeah, I mean, these are the more prominent one that you may probably find on some of the new headlines. But the actual set of default estimated is actually much larger, mainly on the smaller developer, the developer that were very well known in the market.
Yep. Now, there's a whole raft of, and I sort of alluded to this a little bit earlier, there are some policies that are coming out to try to loosen and try to promote and stimulate the property market. I mean, do any of these, going back to an earlier question, do any of these move the Richter for you, Gordon, or are these again reasonably insignificant for the time being?
I think individually you could look at it as insignificant, because they are small, or tiny steps, right? But collectively, there may be some good direction. No, we don't evaluate each small action by each of these agencies. We mainly look at the trend and the overall impact, the intention of this policy, right? As I mentioned from the last webinar, we expect any policy coming out from the government will be tiny step, and you may not even know if they announce it, because they don't want to make it as a big deal, so that people all of a sudden think that, oh, it's all bullish again on property, because they want to keep property price down, even though they relax. You may not read on the headline on the news, but over time you will feel the overall condition of the property market will get better. Okay, incrementally each day you may not feel it, but maybe over a 2-3 months period, compared to 3 months ago, you will say, oh, it's actually better.
Yep. Obviously, given the largest proportion of the Asian credit market is in the property sector, we currently still have 25-27% allocated to property. Now, from memory, Gordon, I think 65% of the market is property. So, we're significantly underweight, but it's still meaningful. If the property market is so depressed at the moment and, priced accordingly, why do we still have a quarter of the portfolio in property?
Well, first of all, as you mentioned, right, property is still a very important sector, not even in China credit, but it's overall on Asian credit as well. And I think in this kind of environment, if a manager is able to screen out the good and the bad, I think right now is a very good opportunity to buy some of these good names, fundamentally good names, at an extremely cheap price, right? So that's why we have still around 20-25% of the portfolio in property. Those are the names that after our bottom-up research, after our due diligence, we identified those are the good names. Those are the names that basically we expected to be ultimate survivor after this term. Nonetheless, even though they are good, if your neighbor is in the trouble, you will be impacted, right? At least on perception basis. So therefore, the price of the good names also got priced down in sympathy with the bad names. So I think although as a whole the property sector is still not out of the root, it's still pose some challenges. But I think right now is the time that for a bottom-up manager is to really pick good name and buy at extremely cheap valuation. So that's why we still have mid-20s in the portfolio.
Would it be fair to say that staying on this sort of property point here, that because it is very much a moving beast at the moment, and the dynamics of each of the developers are moving quite quickly, that we have been doing some trading around that property sector anyhow, just as certain either news flow comes out or there's certain risks that have been heightened. You've been much more sensitive to that in the last sort of 6 to 7 months.
We do. We do. When we cut property from around at the peak, I think we have something like 60%. Right now we are at 25-27. So we dramatically slash our property exposure, and on the way down, reducing the rate, we actually become much more selective in choosing the names that we want to park our money in, right? So there are plenty of trading happened for the last 9 months just on the property sector. In fact, I have make it mandatory for all the team members of my team to know property, to know China property, whether you are following Southeast Asia or following investment grade, you need to know property, because this is a sector that is deemed to be too important in this environment. So we reduced dramatically, and then we also took the chance to really rotate into better name, as I mentioned, and take advantage of the market of cheap valuation. In the process of it, we actually also trade around a few names.
Yep. Sort of going back a step, if we compare the sort of the scenario of how bad, well, I guess how risky is Asian debt being priced at the moment? Can you sort of talk us through these metrics at the moment?
This is, I believe, is the yield of Asian high yield versus the yield of US and European high yield, right? So as you can see, Asian high yield and basically driven by China, the yield has actually gone through the roof, right? While US and Europe, even given the inflation pressure and the rate hike expectation, on a historic basis, is still trading as a relatively low level, right? So if you don't know what happened in China property, right, and you just look at this chart, just blindly speaking, you can instantly tell, oh, Asian high yield is very attractive, right? Period. It is attractive, but obviously it is not cheap for no reason. The reason was basically China property on this sector. So the key is to understand what risk you are taking in China property, be selective, time your entry and exit, and manage your risk position that way, and also to prepare for these kind of money invested in this space will probably need more time to realize. At some point, this yield will come down. But in terms of timing, it's still, to be very honest with you, even though we are professional looking at this market every day, we also don't have a very high certainty of when this yield will converge.
Mm. I think the other reflection on this slide as well is that there are some parts of the market where it's perpetually attractive, right? There's always been an argument saying, okay, because of the risky nature, there's a risk premium you pay for emerging markets overall, but whether it be equities or fixed income. But what you can see here is that there are certain points in the cycle where, in actual fact, either US, probably more US, and even Euro high yield is more attractive than Asian high yield. It's not that Asia is perpetually attractive, but one of the things that, whether you're looking at it from a equities perspective or from a fixed income perspective, we think there is a very strong argument now, and we've been in the market for close to 20 years now, is that there's an argument to be had of having a strategic asset allocation decision going forward to have an allocation to Asia, not a tactical asset allocation decision, right? But an SAA decision based on the fact of where the world is going. And I'll talk about that a little bit more a little bit later. But if we then also look at the spread difference, basically Asian high yield minus US high yield yields, and also Europe, we're sort of seeing the same pattern here, aren't we, Gordon?
Yeah, I mean, historically speaking, the so-called yield premium of Asia versus developed market in US and Europe, Asian high yield on a historic basis has been yielding around 200 to 250 basis points more than comparable US and Europe high yield. As you can see, sometimes it's more tighter, sometimes it's cheaper. So right now we are definitely in the cheaper camp. According to this chart, about 600 over US and Europe. Back in 2011 or sometime in 16 and 17, there are times that there's really no Asian premium, and even Asian may actually be more expensive than US and Europe. And that's because on a relative basis, during those periods, you can argue US and Europe, the market as a whole was in a relatively worse shape than Asia. Now, if you recall history, there were times in the history that Asia economy, Asian macro and the market was actually better than US and Europe, right? For example, during Lehman, during the great adjustment of the US market post-Lehman, and also when during the Euro crisis, all these Western crises in the Western world, on a competitive basis, Asia at that time and in China at that time was actually more peaceful, right? So people were more willing to pay more to own Asian assets. So, but this kind of cycle, we've seen it for history. That this kind of cycle won't last forever. Sometimes one region is cheaper than the other, and vice versa. So I think to answer your point is even on a normal market, Asia is still yielding 200 over developed market, right? So if you believe Asian economy, and in particular China economy, the China as a country, the politics, all that becomes stable, even though nothing happened, you are making 200 to 250 basis points per year more, even though nothing happened.
Yep. Now, sort of, let's now have a look at the metrics of the fund as it stands, and this is data now ending the end of March. So historically speaking, we have never seen the yield to maturity at over 20% ever in the fund until February 2022. What does that tell us, Gordon? Does that say that we are in for a world of pain, or does that signal a time to invest in your viewpoint?
Okay, I think just to be make a joke, right? So one day one of my clients look at the list of bond, right? So they have the price and they have the yield, two columns together, and then some of these bonds actually you couldn't differentiate whether the column is a price or the yield because they are so similar. Right? You could see a $50 price and then they give you like 30% yield, right? So if you can say that which one is yield, which one is price, okay? So right now, I think going back to the stage of the market right now, we have gone through this for past 24 months at least. So I think right now these 20% and also it is a reflection of what has happened in the market. It reflects the stage of the market. It reflects investor expectation of the market. It also reflects what investors know based on public source, what's going on in the market. So I think right now, and especially if you look at this yield and also look at the standard deviation chart and also compare to history, you can properly conclude that, again, from whatever angle you look at this market, it is cheap. Okay, in terms of standard deviation, China high yield is around right now 3 standard deviation, right? On the cheap side. Asia as a whole, 2 standard deviation. So if you collectively speaking, whether you look at yield, whether you look at spread, look at standard deviation, look at Asian premium, all this, everything points to the market is really cheap. To answer your question whether to get in right now, I think obviously given the valuation, people can look at it. In fact, recently we have talked to a lot of Western clients in Europe and in US. They all looking at this sector. Okay. As I mentioned, investor sentiment right now, the investors are not completely buy-in or completely optimistic. Nonetheless, they have their eyes on the market in China property. They haven't pulled trigger. Some of them has pulled trigger last year. Many of them have not. So I think if you put money right now, we could consider investor right now could be sort of like an early bird.
Yep.
If you have the patience, I believe that that there will be a lot of money to be made in the next 9 to 1 year or so. Okay, but don't expect to make big money in the next 6 months.
Well, and here's the thing. It's interesting, Gordon. You sort of allude to this point of you need to be patient. I think one of the good things in Australia and New Zealand is we don't trade funds. That's not our culture. 6 months is not a trading activity rather than an asset allocation decision. So if I sort of rephrase that point, if people are making a strategic asset allocation now to a sector like Asian credit, because everyone's preparing papers at the moment, right? Preparing for their entry point. If there is a 3 to 5 year investment time horizon, is it actually a good point to get in now?
Oh, definitely.
Yep. Going back to our portfolio and sort of deep diving again here. For those that have invested in the strategy for many years, this portfolio has generally been made up of pretty much 100% high yield. What you can see at the moment in the bottom left-hand side, if we purely look at credit ratings, and again, for those who have followed us for long enough, you know that we actually don't really care about credit ratings. It's not, part and parcel of our investment process per se, because we think it's backward looking. And I'll come back to this point that Gordon, we talked about last week. But what you can see here is that 25% of our portfolio sits in investment grade. That's a historical high. The portfolio is sitting on 14% cash. That's pretty close to a historical high outside of when the fund obviously first launched. So we're like 40% in more defensively invested. And then at the same time we say, but it's a really good time to get in now. So Gordon, from a portfolio construction standpoint, why are we being this conservative right now?
I think obviously the higher cash buffer is a reflection of what I just said, right? But we need to be patient and we want to have dry powder ready when we want to pull trigger. We don't want to buy just for the sake of buying something that we may expect that higher volatility going forward. So the higher level of cash is for us to have enough dry powder when we are ready to pull the trigger. And also investment grade position is 2 things. One is obviously continue our defensive posture. Your IG is more defensive in nature. But I think out of this IG position, we have around, you look at the sector exposure, we have around 5% in sovereign. That is our China government bond inside China, onshore. So they are denominated in CNY. Okay. Why we decide to have 5% inside China sovereign is that we bet on the relaxation measure. where they will obviously they already lower the triple R, and the next thing they will lower the interest rate. So right now is we want to position ourselves to take advantage that yield curve flattening inside China. Obviously, the U.S. Treasury is going up, but inside onshore China, we expect the China sovereign bond, the yield will come down.
Yep. Okay. Yep. The portfolio is currently hedged, so obviously the one feature of this fund, and sort of going back to if we just reflect on the performance line in isolation at the moment, you can see that every time there's been a blip, and it's not like the market that we invest in is not volatile, inherently volatile, and it's not that we haven't had corrections in this fund before, but it's been generally a straight line up until this most recent period of the last sort of 12 months. One of the reasons is because Gordon has the flexibility, given the fact that the portfolio is holding USD denominated hard currency bonds, is that when there is a risk-off environment, Gordon chooses to be unhedged, and as the Aussie dollar falls, it buffers the mark-to-market or unit price losses on paper to protect investors, and it basically has reduced the volatility of the fund. Even during COVID, as you can see here, this was the blip where the fund dropped 7.3% in a month. If it wasn't for the fact that we were effectively 100% unhedged and basically saw the Australian dollar drop from 70 odd cents down to about 58, then the actual unit price movement would have been larger. What we've seen though in this latest correction is that is of a different nature, of which the key reason being it wasn't a global event. Right, and so we didn't see the Australian dollar fall, and therefore a big part of that is we couldn't buffer some of those mark-to-market losses. Right now, Gordon has chosen to be hedged at 80% back to the US dollar, back to the Australian dollar. Sorry, Gordon, can you sort of walk us through why you are, such highly hedged at the moment?
One thing is obviously we follow the Australian data, and it has been pretty good, right? So you guys can feel it down there. You guys, your life is pretty good down there, right? So obviously the US dollar has been quite strong versus a lot of currency, but one currency that has outperformed the US dollar on a relative basis is only the Australian dollar. If you look at the currency performance worldwide, year to date, only Australian dollar has, kind of followed the movement of US dollar. Mainly because of the swing in commodity price, right? So if the US dollar wasn't that strong and the commodity price is so high, we believe the Australian dollar could go towards to 80 cents instead of right now maybe 71 cents versus the dollar. So when we were 80% hedged, we were in the view that because of elevated commodity price, and also the good data from the Australian government on the economy, I believe there are further room for the Australian dollar to appreciate. That's why we were 80. Right now it's dropped a little bit because of this scare on China's slowdown. But I think especially when RBA actually start raising rate and all this expectation of higher rates going forward for the Aussie, I think the Aussie could back up to at least 75 to 76 cents in my view.
Yep. Okay. There is another sort of point that I want to discuss with you around the current state of companies issuing corporate debt, right, in Asia. And we talked a couple of weeks ago, and you mentioned that there's basically no primary issuance, so there's no new bonds entering the market, or very little. Can you talk us through why that is the case, and has that impacted the way that you're investing?
I think obviously it's the bad sentiment right now, and then the yield is so high, meaning so expensive, right? So in this kind of environment, even though companies need money, they may not choose to come out to the market right now because they're paying a really, really high cost of the interest. Plus, arguably speaking, the entire world economy is slowing. So the funding need for a lot of corporate, naturally will come down, right? So that's together basically has caused the primary market to, kind of have a very has reduced activity for a very very large degree. So that's why we haven't seen much new supply in the market. But if the market turns, if the economy gets more stable, and investors believe that the entire world has restart from a new footing, then I think some of these companies will start to come out again. Right now, even though company issuing new debt is really not for new funding, it is really for refinancing old debt into new one.
Okay. I mean, and sort of talking about that refinance, obviously one of the things that, we've been asked is, okay, so none of the bonds that we're holding is defaulting. There's no primary issuance. How, are bondholders currently being actively engaged by, the companies and saying, hey, can we just roll over this debt? And you as an investor, are companies coming to you as the maturity is coming, saying, can we just roll over the debt, same terms, and just roll for the next 3 years? Or, are you asking for the capital back and say, we'll look for other opportunities? Or does that actually potentially exacerbate the problem?
I think there's different way to roll the debt. You either go to your investor and say, just roll it, okay? Just extend, I don't know, 3 years, and then maybe keep your coupon, or even maybe a little bit lower. Or alternatively, you can ask investor to, you can issue a new debt, but you use the proceeds from the old debt to reinvest in the new debt. So that will separate one deal versus the other.
Yes.
Personally, I prefer the second. You want to finish the existing one first and then start new one, instead of, okay, I just blindly roll whatever I have to the next one. Because I think in the process of using the proceeds from the maturing debt, investing in the new debt, investor can take the advantage to renegotiate, okay, whether it's the coupon or whether it's the size that I roll, or the maturity of the tenor of the bond. So I prefer that way.
In the last sort of 12 months for the debt that's been maturing on our portfolio, have you seen more of number one or number two?
Some number one, some number two, but smart company will do number two. Dumb company will do number one.
And I mean, the debt that we're holding, the other thing, the other, I guess the other point to note is, I mean, how often are we actually, literally holding the bond or the security till the maturity date, and then a negotiation starts or the capital gets paid back, or are we actually getting out before it actually matures?
Usually, none of our position is marked at hold to maturity. Every position in our portfolio is tradable. We're ready to trade anytime. If we see the price and we see the market. So to answer your question, that after we do our work, when we can have reasons to believe that a bond could be extended, then most likely we will just reduce or sold it beforehand. And then when the new deal comes in, we will look at it again and whether we want to participate or not.
Yep. Okay. I guess final question from myself before we take a look at the questions from the audience. Obviously, traditionally, our portfolio has had a reasonable level of turnover, okay, because it's an active fund, it's very dynamic. And right now, if you, again, looking at these metrics, the yield to maturity at 20%, cash yield's still solid, nothing's defaulted, the income's coming in, it's all mark to market. The argument I put to you, Gordon, is let's just hold on to the 86 bonds till they mature, and we're going to make a ton of money, are we not?
For the lower dollar price one, yes. But for the lower dollar price one, and we believe that they will be ongoing concern after this downturn, yes. Okay. But if a bond right now is at, let's say, above 90, and they have maybe 2 years to go, I may choose to swap it into something cheaper.
Yeah. Okay. So you want to trade for some gains incrementally.
Correct.
Yeah. Okay. Yeah. And how much? I mean, how, sort of in a round number sense. I mean, how much of the portfolio do you think sits in that category versus the ones that is really, really cheap and you just want to hold through to maturity? Are we talking like, a quarter of the portfolio you want to keep trading around to make incremental gains, or is it like half the portfolios like that?
I think generally speaking, you can imagine our IG position is closer to the trading camp because those are, arguably higher dollar price, right? And it's very sensitive to the interest rate expectation. So we tend to trade a little bit more on the IG position. For the high yield, because right now the valuation is so depressed, you can just close your eye. You identify all this name, close your eye and buy those bonds and just sit there for a more longer period of time.
Yep.
So high yield is more holding right now. IG, government bond, and also the interest rate futures. Those are the trading positions.
Yep. Just to talk about distributions is something I alluded to earlier. A lot of our investors have been asking, okay, unit price movements are unit price movements, mark to market, no defaults. Are we solidly finding that our income consistent, and is our income, consistent going forward? So what I decided to do is I got the team to sort of produce this chart and just to show on a financial year basis what the distributions have been on the fund since inception, 10 years ago. And what you can see here is that, we have paid distributions out of at least 6% every year. Now, obviously in FY12, slightly short, it's a bit lower because there wasn't a full financial year. And then FY22, we're 3/4 of the way through, right? We've paid 4.5%. So, through the life of the fund, we've paid, on average higher than 6%, but it's been at least 6%. And so, Gordon, going forward, are you still comfortable that we're going to achieve the 6%, distributable, distributions to our investors based on the fact that we have a cash yield of over 6, and the yield to maturity is 20?
Yeah, I mean, the cash yield right now is close to 7%, right? 6.9
Yep.
according to this chart. So the dividend is serviced by the coupon from the underlying bond, not from the mark to market of the underlying position. So we will continue to try very hard, and we will see.
Another sort of interesting statistic I want to show everybody. Gordon, can you see this on the screen?
Yep.
Okay. Yep. So what we've done is, in the last hour just before, we had an idea, and we also want to show this up on screen, is to look at the worst 3 or the widest spreads we've seen between the cash yield and the yield to maturity since the inception of the fund. Okay. Month-end data. And, when we see the spreads between the cash yield and the yield to maturity be really high, we wanted to see what is the forward 12-month return. Okay, so in July 2012, cash yield was 8, yield to maturity was almost 16. The next 12 months, investors got 11% total return. Then November 2018, something similar happened. Investors got 17% total return. Then in the COVID crash, where the difference was about 7%, yield to maturity is 16%. For the next 12 months, investors got a total return of 15%. This time it's even more severe, and obviously, as I said before, we've never seen the difference, or we've never seen a yield to maturity higher than 20% before ever in the history of the fund. This is, the big question mark that we have. Again, we're not saying that, history, speaks to future returns at all, but this is the 3 widest points we've seen in the portfolio historically, and what the next 12 months return has been. So the argument that sort of we're putting forward, today is, okay, if you're in the camp of already being an investor and already in the strategy, why would you stay? Or, why would you not sell out now? Well, you're selling out at a pretty, depressed point. And, I don't need to speak to everyone here as a professional investor on the call. And you well know, what happens when you sell at the bottom of the market. And then for people that are going forward, the yield is attractive. And even for those that are currently in the fund, the yield is still attractive. right? We have consistently proven that over the last decade, we continue through ups and downs, that we are consistently maintaining those distributions out to investors. And that's the critical point, which is again what a lot of the New Zealand investors have been asking us in the last couple of months. Now, with that, I'm just going to take down the slides and sort of want to address some of the questions. So I'm just going to play with the tech here. And so, you know, Gordon, I can sort of answer this question, and then we can get your take on it. A question's come up is, how can China fully return to the global market economy if it continues to maintain a zero COVID policy? As soon as international travelers return, COVID is just going to be imported again. So let me start by saying that the one key differential at the moment between what we're seeing in China versus what we're seeing in the rest of the world is that the vaccines that the Chinese have used to combat COVID domestically, mainly being Sinovac, is actually not as effective as Pfizer or AstraZeneca. And this is the key problem. This is why Shanghai went to lockdown. They well know that the domestic vaccines are not as effective, but they came out very, very early with the vaccine. There is an mRNA vaccine currently in a third stage clinical trial to about 20,000 test cases in between Indonesia and Mexico, because the Chinese authorities wanted to use it in a country where the case numbers are quite prevalent to test out its efficacy. And so, you know, the government is trying to ensure that it boosts its population using a higher efficacy vaccine, because every country, whether you're China or elsewhere, needs to at some point learn to live with having COVID. So China will return. I think the other interesting point to note as well with this question is that if China doesn't, you know, return to the global market economy, the rest of the world is actually in very, very deep trouble. And this is a conversation, again, we were having with our New Zealand investors yesterday. You remember that in the world, there's 200 odd countries or 300 odd countries. 140 of those countries, the largest trading partner is China. So if China doesn't return to the global economy and remains insular for, you know, for the foreseeable future, the rest of the world is in very, very deep trouble. Gordon, is there anything you want to add to that?
Yeah, I absolutely agree what you say. Right now, I think the Chinese domestic vaccine is really important. As you mentioned, that the activated version of the vaccine hasn't been as strong as the mRNA. And China they're producing it themselves. So watching the pandemic situation in China is actually really key. And I also very agree with you saying that if China is not doing well, the rest of the world will also not doing well, because being the biggest manufacturing base, being the worldwide factory, that a lot of these places and will be at least on the inflation front, globally, everything will become more expensive. You know, if China's going to slow down or even shut down.
I mean, even with the Shanghai lockdowns, we have seen global impacts to supply chains already, right? That there's no doubt about it. It's bad. And so the quicker that Shanghai gets out of lockdown properly, and there is loosening that's coming through now, as cases come under control, the better it is for the rest of the world, Beijing included as well. The other question that we had was, what is your view, and this is sort of forward-looking, I guess, what is your view of the implications of the CPC National Congress meeting later this year for the Chinese economy, financial markets, and obviously the fund that you manage, the income fund?
I think the most important thing is to see whether Xi Jinping will get re-elected. The expectation that he will, right? And once that taken aside, and then I think Xi Jinping will have more time to really, you know, care about the economy. I would say from today up to the meeting in autumn, I think he needs to drum up the internal support for their own party so that he will be elected. So therefore, in view of that, controlling the COVID situation will be very, very, very important for Xi Jinping's political career. Honestly speaking, economy right now has slowed down. I'm sure the government knows about it, But I think in order to the economy to get better, they need to get the COVID situation in control, and that will allow the country to reopen and all the manufacturing to resume. Right, so I think it's also consistent with what I said, right? You know, everything would likely to be better than today, but whether from property or the general economy of China in the second half of this year.
Yep. Yep. I mean, is there a risk that President Xi, in your view, won't get re-elected in October?
You don't want me to be prosecuted, right? If I answer this question, I don't know. I don't know the expectation that he will. That he, unless he's facing very, very strong opposition from the CCP party, that you know, never say 100%. No, even though right now, if you read some media, you know, some media suggest that you know he is facing some opposition because the way that he handled the U.S.-China relationship, how he handles the COVID zero policy, and all these all he has, some of the aspects that he has done for the past few years has drawn some opposition internally. But expectation is that he will likely be re-elected.
Yep. I think the other reflection that we have here is that I think it's important to also remember that China, and based on the way it is governed by the central government, there is one inherent benefit. And the benefit is that it can actually take the best parts of Western democracy and their policies and implement it in China in a quite a swift manner. Whereas in the West, with Western democracies, you can't. And one of the sort of the changing tides that we're seeing across the world is that over the last decade, we've seen quite a number of populist governments being elected in Western democracies. And the big push and the big rationale as to why that has been the case is primarily driven by people not being happy with the way that their wealth is growing, or it's not growing, or it's stagnating, or their wages have stagnated. And they're seeing the rich get richer and the poor are basically being left behind. China is well versed, and they're very, very clear on what's happened, which is why over the last 12 to 24 months it has inflicted significant pain on itself for long-term sustainable growth. And I recommend everybody, and this will be my final comment, that anyone who knows about Ray Dalio, he's recently had a new book that came out called The Changing World Order and Why Nations Succeed and Fail. And the rationale of what he's talking about there is basically talking through this critical issue about why the Dutch rose and why the Dutch failed, and then the British rose, why the British failed, and then the US rose, and why the US is currently failing and the Chinese is rising. And the key takeaway to all of that is because countries have gotten to the point where they spend more than they earn. And every time they do that, they start printing money. And over the last 100 years, the US government has gone bankrupt twice. Once in 1971 under Nixon, and once in 1931 under President Roosevelt. In both those situations, they printed money. In both those situations, there was the population was living in excess. And right now, every time you print more and more money and you fight more wars, this is the same pattern that's happened over the last 500 years. China will rise, and China will also fail at some point. But the Chinese government has also watched the history of these nations and worked out, if we can control the population to ensure it doesn't spend more than they earn, and they have aspirations that contribute to the economy, more so than asking a young person, instead of being an engineer, they want to be the next Justin Bieber of the world. China's government is trying to ensure the sustainability and its long-term sustainable growth pattern compared to the West by inflicting itself a lot of this damage, controlling property prices, removing after-school tutoring as a key source of revenue and growth, trying to remove monopolistic behavior from its companies and many of its industries, especially in tech. All of this is going to contribute to long-term sustainable growth. So, this is a painful period for China, without a doubt. But navigating it, and why I say that as the economies are inflicting significant pain on themselves, now is a considerable opportune time to consider a strategic, not a tactical asset allocation to Asia, both for equities and fixed income. And for those of you on the line that are from New Zealand, I will be presenting to you next week, my first trip internationally for 2 years. And I'll also be in Melbourne in early June. And I know Derek will also be in Brisbane shortly, and he'll reach out to those of you on the line from Brisbane and myself from Melbourne. So with that, I don't see any other questions that have come through. Gordon, thank you very much for your time and your frank talk as always. It's good to always be, hearing straight from the horse's mouth. And again, we're not, sugarcoating anything at all, but we're presenting the opportunity as it stands today. And I wish everyone a good afternoon. A copy of this presentation will be emailed to you after, and this has been recorded. So if you want to watch again or forward to a colleague, you'll also receive that recording to share with your colleagues. And with that, thank you, Gordon, and I wish everyone a very pleasant afternoon and rest of the week. Thank you.
Thank you.